First of all, a review of DraftKings. There's only 1 month ago that I was kind of hesitant about this one, right? I saw that the prediction markets, companies like Kalshi were out there getting a lot of sports contracts that were tied to financial products, because prediction markets are not online sports gambling. And the designation is important because this is something that's federally regulated rather than state regulated. So if you have a financial product that is sold as a prediction market, that's immediately available everywhere in the United States. Anybody can place these. We don't call them wagers. You can invest in these financial products that are tied to the outcomes of sporting events. And I said, man, this is bad for DraftKings, right? This is going to be a problem that they're going to steal share out there. You got these up and coming smaller companies that immediately are getting, almost $1 billion per month of sports contracts. In fact, in the most recent month, the New York Times reported that Kalshi had $2.5 billion, mostly from NFL games. I downgraded DraftKings from buy to hold in October, expecting that this was a rising competitive threat. And then I changed my position after thinking about this more. I actually think that now that DraftKings is releasing its own prediction market product, I think this could actually be less of a competitive threat and more of an incremental opportunity. I'm not entirely convinced that its existing customer base, which is operating in the states where online sports betting is already legal, I'm not convinced they want to change their behavior, right? They might still keep using the app. They've already got kind of some personalization stuff set up. Are they going to move over prediction markets? Yeah, maybe, but they'll probably stay within the DraftKings app if they want to do that. So I'm not sure we're going to see as much of a shift of market share as I originally anticipated with DraftKings. And we're going to have to wait a couple quarters, or at least 1 quarter, to see if the fundamental signs are showing that as well. But I do think that, now that DraftKings Predictions is live, they also signed a new deal with ESPN. They were replacing Penn State Gaming to kind of power a lot of the online gambling that was done over ESPN sites, which ESPN is huge, of course, for online sports. And then they've also, on top of all of this, the kind of the cherry on top was they're saying that their stock is, in their opinion, very undervalued. And so they doubled their share repurchase authorization. This is a company that's not been in the public markets that long, is still growing the top line very aggressively, typically not the prototype of a company that would be buying back a lot of shares. But DraftKings is generating a lot of cash, getting about a 10% take rate of a lot of the handle that's placed, the total amount of betting that's done on its platform. With all that cash, and it doesn't have that much of a reinvestment need, it's going to say, yeah, we're going to go back and we're going to buy our shares. They doubled their authorization. I'm going to move DraftKings back. I'm going to move it from hold back to buy